Afternoon, everyone. I can only assume that you're all here because there's a funny guy after me. So I hope you enjoy it. Well, my name is Alex Denny. I'm Head of Investment Trust at Fidelity, where I've worked for the last 12 years. Today, I am indeed going to talk about the history of investment trusts, why they're still relevant today, and how they've kept up with a city that's changed from this to this. Hopefully, it will progress. I don't normally like to dwell on the past, and in fact, I tend to think that talking about 150 years of history makes everything sound a bit fussy and old-fashioned, but I do think that the actual anniversary year of investment trusts this year is something worth celebrating. And you can see here a number of investment companies that have launched since 1868, which are all still available on the stock market today, and there's 7 more that launched before 1900. For those of you who are really geeky, the 150th anniversary investment trust is actually on Monday. So there you go, and you don't hear that every day. So where should we start? Clearly, we are all investors at the Master Investor Show. And investment trusts are great for lots and lots of different things. You can hold them in all the different wrappers you can think of. You can hold them in a SIP. You can hold them in an ISA. But they are such a wide and varied collection of companies that you can use them for nearly any investment purpose, whether it's investing for children, whether it's for a house. All sorts of goals can be reached, and we'll touch on some of the reasons why they're appropriate in that way as we go on. So, what can we be investing for? We could be investing for growth. And some of the ways that we'll touch on the use of gearing that can help achieve that growth. The fact that they're well suited for value investing, and of course they can trade at a discount or a premium that will affect the returns that you get back. Can lead to volatility, can lead to a bit of risk, but can also be quite a benefit. And of course they can also be used for income and dividends. And we'll touch on some of the ways that we do this. Clearly they can take income and produce returns from a whole wide variety of different asset classes not available in most open-ended funds. So we'll touch on some of those. And I know a number of people have come up and asked me in the last few hours about dividend smoothing, and we can talk about how that works as well. So this all starts from a simple question of what is an investment trust? Is it a company or is it a fund? And of course the obvious answer is that it's both. This really does mean, it really drives why investment trusts are still so effective and so relevant today. We'll just touch on a few of these points. They are, of course, collective investments like other funds, and they're a way of pooling assets or pooling the investments of a whole series of different individuals and making a wide portfolio of investments in the same way as other funds. But they do that in this company structure. So they have shares issued on the London Stock Exchange. You can trade them in real time. And as companies in their own right, of course, they also have an independent board of directors. And that is actually one of the really key things that I want to call out within this talk as to why they still do so well today. And I'll also touch on it, probably in the Q&A, on the ability to issue debt. Okay, so characteristics of investment trusts. What do they invest in? Where can they invest? Clearly, they can invest in major equities, blue chip companies, FTSE 100 companies. They can invest in the major indices all around the world, and you can take dividends from those, and that can all be pulled together and distributed. But they can also be used to access much more illiquid markets, the emerging markets, frontier markets, and the very small companies within those. The little acorn here is talking about private equity. You can invest in companies before they've even listed. There's a large sector of that, and it's increasingly common for some of the mainstream investment trusts to do that private equity investment. They can also invest in actual commodities, real stuff, which most funds aren't allowed to do, and of course infrastructure and real estate, which is all great ways of getting differentiated, uncorrelated exposures to drive your investment returns. I thought it might be useful to look at a couple of individual portfolios and how this plays out. So here, Fidelity's Special Values and Fidelity Special Situations, one of Fidelity's managers, Alex Wright. And what I've done here is put a little chart of the market caps of the investments that he makes in the two portfolios. And what you'll see here is that actually they don't look remarkably different. And he's using the same value contrarian approach for both sets of investments. But what you will see in the investment trust is he's got a much larger exposure to the micro cap, really small companies. Because, of course, in the investment trust, where you've got the closed-end structure, you've got a set number of shares in issue, he isn't forced to trade in and out of those companies as he gets flows in and out of the fund. So he can take a good long-term view on illiquid assets, and he can make investments actually in market downturns, whereas normally in the open-ended fund, he's forced out of those really small investments. If you compare that with Neil Woodford, he's obviously a very big name. He's been running funds for a long time, and very high profile, of course, launched the Woodford Patient Capital Vehicle. I'm sure some of you are invested in it, and I hope you're remaining patient because it hasn't quite paid off yet. But it may well get there. But what is really obvious here is that Neil Woodford is doing something totally different in his investment company structure to what he does with his open-ended funds. And again, you've got the exposure to micro and small caps are absolutely dominating his investment company. But the point I really want to draw out here is that clearly investment companies can be used even in equity markets to gain exposures to totally different sorts of companies. But it doesn't mean that you have to. But if you're going to really leverage the advantages of an investment trust, you should use that closed-end structure. So quite commonly, illiquid assets, smaller companies, things like that are a good way to start looking. Now, I talked about company structures and boards, and clearly shareholders appoint a board, and they then appoint an investment manager like Fidelity. I think the really key thing here is that ultimately the shareholders genuinely are the owners of the company, and they're also, of course, the customers of the company, which is a bit different to how open-ended funds work. But the thing that I think drives performance so well, actually, in investment trust, is the ability of the board to remove that manager. Now, they don't actually need to go ahead and do it all the time, but simply the threat of being able to do it is enough to make sure that investment managers keep good portfolio managers in there, that they're monitoring the performance, and you don't end up with the sort of the dead wood. And so, catchy little slide here, reinvention avoids dogs. There have been some really high-profile changes of managers in recent years. Alliance Trust, which was one of the oldest investment companies I flagged on the first slide, fired itself as manager, which is quite an achievement, and appointed Towers Watson. British Asset Securities fired its manager and then fired it again, changing to BlackRock and then on to Aberdeen. And down here, Fidelity Asian Values, we didn't fire ourselves, but we did decide that we ought to change the individual portfolio manager to get much more exposure to those small companies, illiquid companies. And so now we've got a portfolio which is nearly completely differentiated from the MSCI Asia Index. This all leads to better performance. And one of the key things I think that's important in this slide, and by the way, what this is doing is comparing funds with the same manager, very similar strategies, but in open-ended and closed-end worlds, so things like Fidelity Special Values. But of course, if you look over the history of open-ended funds in general, if a fund starts doing not very well, it might take quite a long time for the assets to be sold off, and those funds will continue being a drag on performance for years and years and years. But an investment trust board can simply fire the manager and reinvent itself, and it might change strategy completely and do something completely different. So Foreign and Colonial, the first investment trust, started investing in effectively government bonds from what were emerging markets at the time, and now it's a major equity investment company. So how would you use them? Well, clearly, it's a great way of getting differentiated exposure. I wouldn't say you should only have investment companies doing weird alternative stuff. You want to have a kind of a good core portfolio. But if you want to get your uncorrelated sources of return, so you want to buy into real estate, you want to buy into infrastructure, you want to get private equity, then the investment company structure is absolutely ideally suited for that. So what role can they play? Well, clearly, they are also an important part of the mainstream investment universe, so you can get your core equity exposures from investment companies. And actually, investment companies, there's about 125 of them in the FTSE 350, so there's a lot of product out there. You can use them to get long-term capital growth for asset diversification, and of course, income growth and consistency. Which leads me nicely on to the AIC's catchy title, the Dividend Heroes. These are companies which have increased their dividend year on year for many years. The top 5 or so have done so for half a century, which is a pretty impressive record. There's loads of companies which have increased their dividend for 20 years or more. And I think, if you think about companies like F&C that have been around for 150 years, they can actually carry on doing that for quite a long time from now on as well. And of course, across a different range of sectors. I was asked for recommendations. I don't really do personal recommendations, but what we can share is what are the best-selling investment companies on Fidelity's platform. Scottish Mortgage, very, very popular, of course. Fidelity China Special Situations, I'm very pleased to see up there from my own point of view. But what is interesting here is a lot of people talk about investment trust for income, but most of these, or the majority of them, are actually growth-focused trusts, but they do also pay dividends, and many of them have been increasing them for quite a long time. And so I've done this little color coding of the income focus, but I do know that a lot of investors are focused on income, and that's likely to be a growing trend with increases in interest rates, inflation, and I know that people are going to be seeking indexation. So I've talked lots of nice things about why investment companies are good. Aren't they risky? Well, clearly, there are risks that people need to understand. There is a liquidity constraint because they've got a set number of shares in issue. If there's lots and lots of demand but not as much supply, that will drive discounts and premiums. So it leads to this extra sort of influence on returns, and if you buy something at a high premium and it goes to a wide discount, then you will end up eroding your investment returns. But conversely, of course, if it goes the other way, you can do quite well. Gearing, I said I'd touch on this briefly in terms of debt. Clearly, investment companies can borrow money from the bank. They can also issue debt in the form of bonds or debentures. Foreign and Colonial this week announced it's doing a 30-year issue of debt at, I think, 2.7%. And if you think about that, this company has been around for 150 years, so they can take a 30-year view on what they think is going to take, what's going to happen to interest rates. Very commonly these days as well, people use derivative structures to achieve gearing to gain extra exposure to the market. Clearly, it's a risk. If markets go against you and you're highly geared, then you will fall in value faster. But actually, most companies aren't investing on a structurally geared basis. They will use gearing tactically. And if markets have fallen, what companies can then do is go and borrow more money or make further investment at lower asset prices, which is actually completely counterintuitive to what happens in the open-ended fund world, where markets fall and people tend to start selling off. So investment companies really can ride out the volatility, but it does lead to a level of risk that needs understanding. How do you mitigate these risks? Well, I come back again to the board of directors. People worry about discounts and premiums. They don't actually tend to change very fast. They can do, of course. I don't know if anyone saw River and Mercantile go from a 6% premium to a 10% discount overnight. But that happened, of course, because they fired their portfolio manager, which wasn't very popular, but I understand that there were good reasons for it. But the board of directors can influence this stuff, and they can, for example, set guidelines on when they buy back shares to address the discount. They can set limits on the level of gearing, how gearing is used. And of course, you can also keep a close eye. Fidelity's platform has all of the information you would need to see discounts and discounts history. Just be wary, or just be mindful that investment companies are really designed as long-term investment vehicles. They aren't really for high-frequency traders. I mean, there are a number of people who do trade them that way. But if you take a long-term view, I think they can do very well. So, how do you actually buy them? Well, they are available through most platforms. They're available through Fidelity Personal Investing. And we've got lots of information available on our website. You can find out information on our stand. We have a range of over 100, I think it's actually more like 150 now, and very soon we'll have the entire set of investment companies available in the UK on our platform in the next couple of months. There's a brochure about our own range. There's also a cup of coffee, I understand, and there's a competition where you can win an iPad Pro, so please do go down there, meet with our relationship managers. I know that you've been asked to stay here for the comedian, so if you do, you might want to rush down after that, because there's also a few copies of this rather splendid hard copy book that we were involved in producing, but there is a limited number, so you might actually want to run down and then come back again. But please do take the time. And I'm very happy to take any questions. Yes, investment trusts can nearly always buy back their own shares, and they will do so at a discount which will then be accretive to the net asset value of the company, in the same way that other FTSE companies can do so. Any other questions? There's a microphone coming to you, I understand. So.
Thank you very much for a very good presentation. Can I ask, why doesn't Fidelity launch some more investment trusts, its own?
Oh, well, that's an excellent question, and it's certainly something that I would like to do in the future. And we've got lots of capabilities that we would consider putting into an investment company. You're quite right, we haven't done so since 2010, but we are looking at the market closely.
I mean, for example, your open-ended global special situations fund, why don't you have an equivalent investment trust offering?
Well, that's a good question. I think if we were going to do a globally focused equity fund, we would actually want to make it different to the special situations one and do more with the illiquid asset classes. But it is something that we're looking at.
All the rage now is multi-asset investment trusts.
Yeah, well, the multi-asset is something I've looked at quite closely, but there are quite a lot of them now. And what has tended to happen is that investment trusts have turned into multi-asset trusts, which actually is what Alliance Trust did, for example, when it appointed Willis Towers Watson.
Thank you.
Any other questions? Oh, thank you very much.